What Forex algo trading tips do beginners ignore unconsciously? When it comes to Forex algo trading, beginners tend to overlook several important aspects, often unconsciously. These oversights can significantly hinder their success and lead to unnecessary losses. One of the most common mistakes I see is the rush to live trading without a properly tested strategy. Many new traders find a promising strategy online or create one themselves and assume it will work immediately, but they fail to invest the time necessary to properly test it. Testing a strategy involves two critical steps: backtesting and forward testing. Backtesting is the process of running your strategy on historical data to see how it would have performed in the past. This is crucial because it helps traders understand whether their strategy can withstand different market conditions. It also reveals how sensitive the strategy is to changes in market behavior. A strategy that works well during a trending market, for example, may fail during a ranging market. The problem is that many beginners don't realize that past performance, while informative, does not guarantee future success, especially if the strategy is over-optimized for historical conditions. This brings us to another common oversight: overfitting. Many beginners unintentionally overfit their strategies to historical data. Overfitting occurs when the strategy is fine-tuned to such an extent that it performs almost perfectly on past data but struggles or fails in real-world market conditions. Essentially, the strategy becomes too specific to the data it was trained on, mistaking random historical noise for useful trading patterns. This creates a false sense of security, as the strategy looks like a winner in backtests but quickly breaks down in live trading. To avoid overfitting, traders should limit the number of parameters they adjust in their algorithm and always test their strategy on fresh, out-of-sample data. This helps determine whether the strategy is genuinely robust or merely tailored to past market quirks. Once the strategy is backtested, it's equally important to forward test it using real-time data. Forward testing, often done via a demo account, allows traders to see how the strategy performs under current market conditions without risking actual money. Many beginners are so eager to start trading that they skip this step, jumping straight into live markets with a strategy that hasn't been adequately tested. This can lead to unexpected losses, as the strategy may not react as anticipated in real-time environments. Forward testing offers a crucial opportunity to observe how the algorithm interacts with the live market and whether any adjustments need to be made before committing real capital. Another pitfall is the beginner's attraction to high-frequency trading, HFT, strategies, lured by the promise of fast profits. High-frequency trading involves executing a large number of trades within fractions of a second, relying on speed and precision. While HFT can be highly profitable for institutional traders with access to advanced infrastructure, beginners typically don't have the necessary resources or technical expertise. In fact, this form of trading is not suitable for retail algo traders. Retail traders simply lack the ultra-low latency systems, direct market access, and high-end hardware that are essential for successful high-frequency trading. In HFT, latency becomes a major issue. Latency refers to the delay between when a trade signal is generated and when the trade is executed. Even a few milliseconds can result in slippage, where trades are executed at prices different from what the algorithm intended, quickly eating into profits. Beginners often underestimate this risk and don't have the low latency infrastructure required for HFT success. For those just starting, it's far better to focus on longer-term trading strategies that are less sensitive to execution speed and less prone to the issues that come with high-frequency trading. Risk management is another critical area where beginners falter. Many new traders focus so much on perfecting their strategy that they neglect risk management, which is arguably the most crucial part of trading. Even the best trading strategy will fail without proper risk controls in place. One of the simplest and most effective risk management tools is the stop-loss order. A stop-loss order is a predefined point at which a losing trade will be automatically closed to limit losses. Unfortunately, many beginners either don't use stop losses or set them incorrectly, exposing themselves to substantial risk. The lack of proper stop-loss placement often leads to emotional decision-making when trades go against the plan, resulting in larger than expected losses. In addition to using stop losses, Position sizing is an often overlooked aspect of risk management. Many beginners enter trades with positions that are too large for their account balance, especially when using leverage. While leverage can amplify gains, it also magnifies losses, which can quickly spiral out of control for an unprepared trader. Without understanding the principles of position sizing, beginners can overexpose themselves to risk and face significant losses from just a few bad trades. I always recommend using position sizing formulas, such as the Kelly criterion, to determine the correct trade size based on your account balance and risk tolerance. By doing so, you ensure that no single trade will have an outsized impact on your account. Another area where beginners struggle is in adapting to different market conditions. A strategy that works well in one type of market environment might fail miserably in another. For instance, a trend-following strategy could perform excellently when the market is trending but lose money when the market moves sideways. Similarly, a low volatility market requires different approaches compared to a high volatility market. Many beginners are unaware of this and don't adjust their strategies accordingly. Volatility is a key factor that can influence trading performance, and it's important to measure it and account for it in your algorithm. Tools like the average true range (ATR) can help you gauge volatility and adjust your position size or stop-loss levels accordingly. Lastly, many beginners make the mistake of setting their algorithm and forgetting about it. Just because the trading is automated doesn't mean it should be left unattended. Markets are dynamic, and an algorithm that performs well today might not work tomorrow if market conditions change. Regular monitoring is essential to ensure that your algorithm continues to function as intended. Moreover, optimizing your algorithm periodically is necessary to keep it aligned with evolving market conditions. Unfortunately, beginners often fail to keep an eye on their algorithms, resulting in strategies that underperform or, worse, generate unexpected losses. In conclusion, while Forex algo trading offers tremendous potential, it's easy for beginners to ignore several critical tips. By taking the time to thoroughly test strategies through backtesting and forward testing, managing risk properly with stop-loss orders and position sizing, and adapting to market conditions, beginners can avoid many of the common pitfalls that lead to losses. Additionally, recognizing the limitations of high-frequency trading and staying vigilant by regularly monitoring and optimizing your algorithms are key steps to building a successful Forex algo trading career. Thank you for watching.